Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The problem with learning from mistakes is that your mistakes keep changing. The fastest growing department in most firms is compliance. Meetings are proof that work expands to fill the calendar. The budget is always balanced until reality sends the bill. Cash flow is like oxygen. Nobody talks about it until it's missing.
Google has just raised its 2026 AI Capex to $195 to $205 billion, up from $180 to $190 billion, as the AI arms race gets even more expensive. Quarterly spending has surged from around $6 billion in early 2023 to nearly $45 billion today. And it's not alone. Google, Meta, Microsoft, and Amazon are now on track to spend over $725 billion in 2026 alone building AI infrastructure. Investors weren't thrilled though, sending Google stock down 3.5% after hours. Turns out even in AI, bigger bills still make markets nervous. Keep an eye on the 30-year bond. It's quietly telling a big story. UK yields have climbed above 5.5%, the US is nearing 5%, while Japan's 30-year yield has surged to almost 4%. A remarkable move for a country once synonymous with ultra-low rates. Higher long-term yields signal investors want more compensation for inflation, debt and fiscal uncertainty. Stocks may cheer rate cuts, but the bond market seems to be asking who's paying the bill. The Japanese yen has slipped past 163 yen per US dollar, its weakest level in almost 40 years. Tokyo has warned it's ready to take appropriate and bold action to support the currency. But traders barely flinched. Why? Because words are cheap while currency intervention is anything but. With geopolitical tensions boosting demand for the US dollar and interest rate differentials still favoring America, the market seems happy to test Japan's resolve. Unless policymakers back up the warnings with action, the yen may keep sliding and the market may keep calling the bluff. Here's a chart that challenges a popular market myth. Over the past 20 calendar years, mid and small cap stocks have consistently outperformed large caps in strong bull markets. In 2009, mid caps surged 114% and small caps 117%, comfortably beating large caps. The pattern repeated in 2014, 2017, 21, 2023 and 2024. Large caps usually come out ahead only during difficult years like 2008, 2011 and 2018, not because they rise more, because they fall less. So the real question isn't large caps versus small cap, it's your conviction in India's growth story. Gold prices may have tripled since 2018, but here's a surprise. Mine production has barely grown. Even more striking, major new gold discoveries have collapsed over the past 3 decades. Normally, soaring prices encourage miners to dig more and discover new reserves. This time, that response is missing. It's a reminder that finding gold isn't as simple as turning on another drill. With supply struggling to keep pace and central banks continuing to accumulate the metal, the supply-demand equation remains tilted in gold's favor. The AI spending spree is impressive, but here's the catch. Hyperscaler depreciation could consume as much as 98% of the underlying net income by 2033, even assuming 12% annual profit growth and a generous 6-year life for AI chips. In simple terms, today's AI giants don't just need a hit product, they need to create an entirely new generation of blockbuster businesses just to justify the investment. The AI race isn't just about building smarter models anymore, it's about building profitable ones. Wall Street is steering the Capex today, but eventually it will want to see cash flows and not just GPUs. Here's a reminder that in global trade, distance is inflation. Saudi Arabia rerouted exports to avoid the Strait of Hormuz, but now disruptions around Bab-el-Mandab are forcing cargoes to take the scenic route through the Suez Canal and around the Cape of Good Hope. A voyage from Yanbu to Taiwan has ballooned from just 19 days to 48 days. Fuel costs have jumped from $1.26 million to $2.87 million, with another $1 million in Suez transit fees. The oil is still flowing, but is taking a much longer and far more expensive holiday.